In this video, we are going to go over some key elements of active investment management. There is active management and passive management. Passive management, in the simplest form, you pretty much put your money on some kind of portfolio or set of assets, and you just let it sit there for a while, and it runs its course. And from time to time, you remeasure and rebalance. Active management seeks to continuously monitor the market and try to time it with its ups and downs and take advantage of those changes. So here are a few things that play a part in active management. And first, we'll talk about some performance measures. There are several out there. We're just going to talk about these three for now. We got the Sharpe ratio here on top. We got the trainer ratio and the information ratio. Under definition, what you really have is the formula. Excess return here would be the returns of the portfolio minus the risk-free rate. And that's what we're going to call excess return. Same excess return down here. Once we take the returns of the portfolio minus the risk-free rate, in order to really be able to see what the portfolio did, and the logic behind that is that the risk-free rate is a return you could get with zero risk. So we control the portfolio for that amount. What's important is how much above that amount did you get for taking risk. So we take the excess return and divide it by standard deviation. Now, this is useful when choosing among portfolios that are competing for the overall risky portfolio. Generally speaking, portfolios as a whole, and you're just comparing all portfolios to see which one's more efficient. This is gives you an efficiency measure. Trainer, very similar to the Sharpe, but instead of dividing by the standard deviation, it divides by the beta. It's useful when ranking many portfolios that will be mixed to form the overall risky portfolio. These are not the only applications, but it's just to give you a guide of what's going on. Here, you're choosing a portfolio. Here, you're ranking them to eventually combine them. Information ratio. You take the alpha, and we're going to talk about Jensen alpha in the spreadsheet video where we do this in Excel. But the alpha is pretty much you take the return of the portfolio minus the required return. So you have expected return, or the average return of the portfolio, minus the required return. Required return here meaning the CAPM formula. The CAPM formula being risk-free rate plus beta times the market premium. That will be the required return. So instead of subtracting the return of the portfolio from the risk-free rate, is the return of the portfolio minus the required return. And if it's positive, you have a positive alpha. If it's negative, you have a negative alpha. You take that alpha and you divide it by this term they call residual standard deviation. We're not going to get, also known as tracking error. We're not going to get into the details about how that number comes about. It will be provided for you here. How to get the residual standard deviation or the tracking error would be for a different course. This is useful when evaluating a portfolio to be mixed with a benchmark portfolio. So you have a benchmark portfolio. It could be the market portfolio in S&P 500 or anything you benchmarking it with. And that you might mix this portfolio with that one. More information, there are more details about the information ratio in the textbook. Now, and these performance ratios are useful, generally speaking, when you're doing active management in order to compare your performance. So some of the problems with these performance ratios, Like everything else in the world, nothing is perfect. They're very useful, but they do have some challenges, some problems. It assumes the fund maintains constant level of risk. While you may calculate average standard deviation, the truth is that returns go up and down, standard deviation goes up and down, betas change a little bit here and there too. So that is assumption that that standard deviation, that beta or that tracking error is gonna stay constant. Particularly problematic for funds engaging in active asset allocation. So the more you change things, the more you move things, the more those levels of risk are going to change. In a large universe of funds, some will have abnormal performance each period by chance. So just by randomness, it just happens, some portfolios, some assets, some funds are going to do really well, or at least above the expectation or the requirement. Some of them may do bad, below the expectation or the requirement. So abnormal performance could mean above or below. They could do better or worse. Then there's their survivorship bias. That line there says upward bias in average fund performance due to failure to account for failed funds over sample period. So this is an issue with technical analysis, and it's related to this fund maintains constant level of risk. So we use the historical performance, risk, and return, and there's this assumption that it's going to continue moving forward and going into the future with the same level of risk and return. However, what happens is that history behind these funds, these assets in those funds, has a survivorship bias, because as either companies disappear or funds fail, they move out of the data because they're not there anymore. So you're calculating performance from only the ones that survive, in other words, the winners. So that's why the upward bias. Market timing, just like it sounds, that people that practice active management are trying to time the market, meaning that the market goes up and down, and they're trying to, I guess you can say, guess ahead of time if it's going to go up, when it's going to go up, how much is going to go up by, and all those things, and the vice versa also. Is it going to go down? When is it going to go down? By how much is it going to go down? So what you do is you adjust the asset allocations for changes in the market. A typical thing is when the stock market is going down, people shift to bonds, from stock to bonds, for safety. And that's what we're talking about here, shifting between stocks and money market instruments or bonds. When the market starts going back up, people then get out of bonds and shift into stocks. There's a lot of different strategies. That's just one example. Option like if one has perfect ability to forecast. Well, if you had perfect ability to forecast, you can treat it as options. But we have not met yet the person that has perfect ability to forecast. There's very little evidence of persistent market timing ability. What that means, throughout the entire history of finance and the stock market, from time to time, somebody gets, and I'm going to say a little lucky, and they do well. But that word persistent is what matters. It's like winning the lottery. Just because you won the lottery once, it doesn't mean that now you know how to win the lottery. And you can do it again and again and again. So there's very little evidence of persistency, that the same approach and strategy can be repeated. You just, as of right now, they just get a good run from time to time. With imperfect ability to forecast, takes a long time, the horizon to judgeability. So that thing we just spoke about, can you tell if somebody has a good ability? Well, you should have to wait a very long time. We're talking about several years, more like in the decades, because business cycles go in 7 to 10 years at a time. Economic cycles can be even longer. The point is that if somebody just starts having a good run, you cannot immediately say that they have a good ability of market timing. They have to repeat it for a very long time for it to say, well, yes, that works. And nobody has achieved that yet. Now, there are a couple of investors out there. I'm not going to get into the details, the names that have demonstrated, or they're getting close to that long period of time of consistent outperformance. But there's like one or two, and we're not prepared yet to say that that their system works persistently. Judge proportions of correct calls, bulls versus bear. There's one example. So earlier I said, trying to time the market as when is it going to go up and when is it going to go down. So you hear all the time in the news, oh, we predict a bull market, we predict a bear market coming up at whatever date. So you're not going to be correct 100% of the time. But the question is, how many times were you correct? The proportion of the times that you said, yeah, going up, going down. That's it for this video. We will see you on the next one.